Hello, everyone, and welcome to this November 7 Economic Impact video for the National Bank of Canada family. As usual, I am with our Chief Economist, Stéfane Marion. Hello, Stéfane.
Hi, Martin.
Stéfane, we have some pretty good numbers from the stock market for the fourth quarter.
Yeah, after a dismal few weeks, Martin, we're seeing a decent rebound so far this quarter. As of November 4th, the quarter's not over, Martin. But the message that we see is equity markets are doing well across the world, and the bond market has been struggling again this quarter. There might be hope for a better performance in the coming quarters, but important to note that the S&P TSX is doing well. Of course, these are markets' quarterly performance in Canadian dollars.
And let's take a look at the US dollar to see the impact of maybe a little bit of a slowdown from the Fed.
Yeah, and the reason the stock market globally, most regions are doing well, Martin, is because US dollar is finally stabilizing. I think this is an anticipation that the Federal Reserve might take a pause in the not too distant future, although that has yet to be confirmed, Martin. But markets tend to anticipate in the future, right? So US dollar stabilizing, that means that the hopes are that the Fed will be able to take a pause in a not too distant future and then assess its situation. That would be good news for the global economy, because what we're seeing right now is a very tangible slowdown. And if you look at the global manufacturing activity, we're talking about contraction, Martin, and for the second month in a row. So clearly a deceleration is happening, or contraction is happening in certain sectors of the economy.
And Stéfane, that's for the business side, but on the consumer side, some worries on the horizon.
Yes, but Martin, if the Fed hopes to cool inflation, consumer inflation, CPI, clearly you have to see some cooling in certain indicators. And what we're seeing now is that consumer confidence is at a record low across the OECD. And that reflects the fact that consumers are hit left, right, and center with higher interest rates, higher food prices, higher energy prices, and also certain asset classes are coming down in prices, such as the housing market. So clearly not a very joyful mood for consumers across the world.
And in order to go by, actually, we've seen the U.S. consumer digging in their pockets.
Yeah. Even though that's interesting, because even though the gross domestic product, so economic activity, surprised in the third quarter after two contractions, it was a rebound in U.S. GDP. That was achieved on the back of consumers who had to lower their savings rate in order to consume, and savings rate in the U.S. is back to the lowest level that we've seen since 2007. So less firepower on that front for sure, Martin, in the coming months.
And another element affecting the consumer is housing prices.
Yeah, so if you want to reduce consumer spending in order to reduce inflation, drop in confidence, lower savings rate, but on top of it, you have a negative wealth effect coming from home prices that are falling, Martin. We've seen a drop in Canada in recent months, but this is also happening in the US. And note on this chart, Martin, that home prices increased more than in Canada during the pandemic, 56% versus 48% on this side of the border. Both countries will show a drop. We're expecting 15% in Canada and between 15 to 20% in the US. So the wealth effect will not contribute to more spending, quite the contrary.
Let's take a look at profit expectations and, again, some worries on that side.
Well, I think what's key also for central banks, if you want to cool inflation, you want to reduce the hiring cycle. You don't want to collapse it, Martin, but what we're seeing now in the US is that the share of US corporations that are guiding upwards for their earnings per share for the coming year has come down significantly. It's actually the worst diffusion since the pandemic. Only 20% of corporations are guiding upwards. And at the end of the day, under these circumstances, Martin, what you're seeing across the world is that even though we've seen this rebound in equity markets so far in Q4, we're waiting to see what happens with the Federal Reserve, because most equity markets are in bear market territory, 20% or more.
But Canada's resisting.
Yes, that's interesting. Down only 12% since the peak. And that is a reflection of some resilience of our economy, but also the composition of the S&P TSX that is more skewed towards commodities, and commodities are really helping maintain some higher levels of profits than would otherwise be the case.
And Stéfane, we had some good numbers. Again, the labor market surprisingly strong.
Yeah, but there's a twist on that, Martin, because yes, labor market surprised on both sides of the border. However, with this uncertainty regarding the earnings outlook, corporations are more cautious. And yes, they're adding to total employment, but note that full-time jobs have stalled on both sides of the border. So what it seems to indicate, Martin, is corporations are more likely to go into a hiring freeze scenario as opposed to outright layoffs. That's why people that were claiming that both Canada and US were already in recession, the last employment reports actually dismisses that view. They're saying that it's a hiring freeze, it's stall speed, but it's not the major contraction that we've seen in the past that would qualify as a real recession. So the jury is still out in terms of what type of slowdown we'll see.
And Stéfane, we had 50 basis point, not 75. Your take on this?
Well, I think from a Bank of Canada standpoint, they could afford to surprise market and by being less aggressive because inflation is clearly decelerating on this side of the border, not the case in the US. And I think there's a reason for that. I think people forget that when it comes time to analyze the impact of higher food and energy prices, particularly on the energy side, on the energy front, particularly as we soon to enter the winter months where people have to heat their homes. And electricity is a really important component. What we're seeing in Canada versus the US is electricity prices are much more stable than we've seen in the US, an increase of 5% since the start of, or 6% since 2019 versus 30% or so in the US, much more than that in Europe. So that explains why the savings rate in Canada is a little bit higher than what we're seeing in the US, but at the same time, it helps explain why you have this faster deceleration of inflation.
And we have to be careful. There's a huge difference between Europe, the States, and Canada on that front.
Oh, absolutely. But the key message is that if you're trying to explain the resilience, Canada versus the others on the consumer sector, well, energy has been much less of a drag for household expenditures.
And another reason to explain how Canada is doing is demographic. And we talked a lot about the 500,000 new immigrants to the country.
because Martin, we're getting a lot of questions as to why are home prices, why are we expecting only 15% decline versus others that are claiming much worse than that? And the reason why we're a little bit less pessimistic is the reason that we still have these great demographics that support the housing sector. And the federal government upped the ante last week by announcing its intention to welcome 500,000 people a year. And most of those are economic immigrants that supports household formation, thus limiting the downside to home prices. And Martin, at the same time, it increases your taxpayer base, which is really important going forward if you want to keep your social programs the way they are right now.
So, Stéfane, in conclusion, a similar message as last month. We're not in the recession camp. We still believe there's a slowdown, but not a contraction of the economy, right?
Well, economic slowdown for sure, Martin. Outright layoffs on a significant scale for North America that would qualify as a real recession. Again, the jury is still out on this one. But Martin, again, to get to the scenario that we're forecasting, we need the central banks to take a pause. And again, I insist on the fact that it's great news for Canada. Now we need better news on the inflation front for the US. So we have to play defensive for the next few weeks in order to confirm this slowdown on inflation.
So we remain prudent. Lots of volatility, maybe some more interest rate hikes, but modest.
We're hoping that come December, the central banks will be able to take a pause, and that would be great news for the global economy in order to not fragilize what is already an incoming slowdown even more.
Thank you very much, Stéfane. Thank you for listening to us, and send us your comments. We'll be back in about a month. Thank you.